Hey everybody. So as promised, I'm going to show you in these videos how to implement the integrated cost leadership strategy. So we need to see where our strategy came out, ask ourselves the questions, what was your intended strategy and what was your actual strategy? So if you'll recall, for this particular company in the other videos, I talked about implementing a differentiation strategy. And if I take a look at my comparative competitive efforts report, I do not have the differentiated position. There's a company E that's making a 5.5 star camera. Company C is making a 5.4 star drone. 5.4 star camera. And then if you look, company C is making a 5.4 star drone. So my 5 star camera did not wind up as a differentiated provider, so I'm going to step back and run the integrated differentiation strategy. Remember, the heart of the integrated differentiation strategy or the integrated cost leadership strategy is to provide superior value to your customers. So my plan is to provide the 5 star camera, and I think I'll probably move to a 5.1 star drone just to be a little bit separated from company B, a 5.1 star drone, and I'm going to offer a superior value for my customers. So in order to do that, I do need to take a look at the action capture camera benchmarks and the drone benchmarks to make sure that my production costs are not too high. So I have a 5 star product. The industry average is a 4.6 star, and my costs are almost the same as the average in the industry. So that's a really good thing. And looking at the drone, my costs are a little bit higher. The average drone is a 4.4 star. Mine is a 5.0 star, but my costs are $128 higher than the industry average. So I'm just going to take a look at that and make sure that my costs aren't too high for me to run the chosen strategy, and they are not. So I'm going to go back to my product design, and I'm going to leave my camera exactly the way that it is, and I'm going to put my drone to a 5.1 star. Now, as you can see, my drone already came in at a 5.1 star. My costs are $1,008.61. Last year, my drone costs were $1,051, so my costs are actually going down based on what I did with my heavy emphasis on research and development. So what I think I might do is I might see if I can pull $1 or so out of my costs. And unfortunately, I can't reduce any of my inputs to make my product more cost effective. So if I take $1 out of these product enhancements, then I lose my PQ rating drops. I will see about my product R&D expenditures. So looking at the camera benchmarks, I've got $61 million invested in R&D on the camera. That's about average. I think I'm going to leave it where it is. And on the drone, I've got $60 million invested, and that's a little bit heavy. So I can probably take some of my drone investment out. I'll drop that to see what happens if I drop that maybe to 21 million, and maybe I put a little bit more here. So I'm dropping my R&D simply to retool my drone a little bit and to stay in line with what the industry standards are for R&D for the average company. And I actually was able to put in an additional 3 minutes of flight time, which is highly desirable to my customers. And I decreased my R&D. It gave me a 5.2 star product for $982. So that's going to be what I go with. Okay. So getting at the heart of pricing is a little bit difficult and a little bit cumbersome, and you're going to have to use your calculator and follow me here. So the camera average industry price is $251, and the average PQ rating is 4.6. So I'm going to do some math. Okay. I'm going to try to shift my share from my screen to my calculator. Okay. And I'm going to take the industry average selling price, which is 251, and divide that by 4.6, which is the industry average PQ rating. And that average price is 251 divided by 4.6. That gives me $54.56 per star. So that is 251 divided by 4.6. And the place I get those numbers from is the industry overview. And my camera is a 5-star product. So I'll simply multiply that 5 and I get an average selling price should be $273. So I'm going to now go back to my action capture drone marketing, and my selling price should have been $273 if I'm going to offer an average value. Okay, so I'm going to change my price to $273. I'm going to change that in all 3 geographic markets. And I should see a big increase in demand when I do that. So I see an increase in market share in North America, in Europe, Africa, in Asia Pacific, and in Latin America. You also have to be cognizant beginning in year 7 of the fact that you're going to have exchange rate adjustments. Globus makes it really easy for us. They put a line in our action capture and drone marketing that shows you the exchange rate adjustment. If the number is positive, that means that you're benefiting from a exchange rate adjustment, and we can actually lower our price such that our net revenues remain close to one another. So I'm going to lower my price in North America by $8 to $265. In Europe, Africa, I need to raise my price by $10. So I'm going to raise it to $283. In Asia Pacific, I can lower my price by $3. And then in Latin America, I need to raise my price by $3. So when I do that, my net revenues are pretty close to one another. They're all plus or minus $1 from 271. Okay, so 271.76, 270.79, 271.77, and 271.09. So that kept my net revenues the same. What I did was I adjusted each price based on the exchange rate impact. Now, I also want to look at the competitive efforts again to kind of get some idea of what the industry looks like. So for sales promotions, the average is 3 weeks at 14.4%. The average warranty period is 87 days. So I'm going to go back to this to make sure that I have a good warranty, and I've got 120 days. I want to increase my sales promotions to 3 weeks just to be in line and consistent with the industry averages. And I also want to make some adjustments here on my marketing spend. So I'm going to leave North America at 4 million. I'm going to increase Europe, Africa, probably to say 3.4 million, and Asia Pacific, and I'm going to leave Latin America where it was. Okay, so I'm increasing my marketing spend a little bit. What I want to do is I want to make sure that I'm utilizing 100% of my facility. And I've raised my price, or excuse me, I've lowered my price and I've increased my marketing such that I need some additional workstations, and my demand is actually too high where it is. Okay, so I go back, I'm going to adjust my marketing mix by raising my price. And what I want to do is raise my price incrementally until I lose demand. And then I want to continue to raise my price to optimize my price until I lose demand again. Okay, so watch what happens to unit demand as I incrementally raise the price from 272 to 273. I lost demand and lost market share, but I'm going to continue to raise that price until I lose additional market share. Okay, and then I'm going to stop there. Going back to compensation and facilities, I reduced demand such that I only need 20 additional workstation spaces. At this point, I'm going to probably put some more money into training my employees, Remember, if I do it in one factory, I'd also do it in the other factory. I'm going to pay my workers better. I'm going to increase my assembly quality incentive, and I'm going to give a good raise in benefits to my employees. Okay. So doing that got my need for additional workstations down to simply 20, right? So I'm just doing the same thing in the other factory. Now I'm down to 17 additional workstations. So I'm going to go back to action capture camera marketing, and I'm going to increase my price yet again until I lose market share to see what that does to my compensation and facilities. Now I'm down to just needing 8 additional workstations, and I'm going to stop right there. Okay. So on action capture camera marketing, I've used price as the primary variable to decrease demand such that I'm maximizing my operating profits and my operating profit margins. Okay. So I did adjust my marketing mix. I want to make sure that none of my retailer support budgets look out of line. They're all about $7.50 or so. My discounts are all in line. My advertising budgets are in line. I had good outcomes last year when I gained stores, so I'm going to leave those all the same. Okay. So back to product design. I've got my cost down to $160.53 on my camera, $160.53. And I'll take that all day long when the industry average last year was 161.18 for a 4.6 star product. And I've gotten mine down to 160 for a 5-star product. So you see, I have a competitive advantage in the way that I'm manufacturing my product. And I'm offering my customers a superior value by offering a product that's above the mean, but still for a competitive price. So for the drone, I'm going to go to the industry overview, and I'm going to take a look at that. And I'm going to emphasize here what I'd like to show you. Our average selling price for the drone last year was $1,268, and the average PQ rating was 4.4. Okay. So I'm going to take those two data points. I'm not going to put my calculator back here simply because I don't want to have to switch windows. But I'm going to take 1268. 1268 is the average selling price last year in the industry. I'm going to divide that by 4.4, which was the average PQ rating in the industry. Then I'm going to multiply that. That gives me $288 per star. I'm going to multiply that times my 5.2 star rating on my drone. And that tells me that my price should be in an average of about $1,500 per unit. Okay. So I go to my drone marketing. I'm actually going to put that at the $1,498 that it showed me. Okay. So at $1,498, my demand, my market share is down a little bit, but my demand is actually up across all 4 of my regions. Okay. So I'm going to now adjust my marketing variables. I'm going to go to $5 million there. I'm going to go to $4 million there, $3 million there, and 2.6 million there. What I'm doing here is I'm matching the number of online retailers. I've got 52 online retailers, so I'm spending $100,000 per online retailer for a total of 5.2 million. And I'm matching that also on my search engine advertising, spending $100,000 per. Okay. That puts my average retailer recruitment budget at roughly at $100. The industry average last year for retailer recruitment was about 130 across the board. So I might increase that just a little bit there. I want to take a quick peek at compensation and facility. So it's showing me that I need some overtime in order to meet demand. Oops, I didn't do the 3% right there. Make that change before I go back, okay? So for UAV drone marketing, I need to adjust again my price for the exchange rate adjustment. And Globus gives us the adjustment that we need to make. So you're going to take the first column here. That tells me I can reduce my price by $47. So I'm going to go to $14.51. Here it tells me I need to raise my price by $56. I'm going to go to $15.54. Here I can lower my price by $18, almost $19. So I'm going to go to $14.79. And here I need to raise my price by $18. So I'm going to $15.16. Okay. So you see my net revenues are all right around that $14.96. I could tweak those a little bit, but that's close enough. Okay. So going back to compensation and facilities, now I need 11 additional workstations. Okay. I'm going to increase my price a little bit until I lose some demand because I don't want to have to work that much overtime. So I'm going to increase the price in every market by $10. Okay. And when I do that and go back to compensation and facilities, I'm down to 9 additional workstation spaces. I'm going to raise my price again by $10 in every market. Okay. And when I do that, I should lose some more demand, and I'm down to 7. So I'm satisfied with that, just to give me a little slack. Okay. So that's my changes that I make in marketing to optimize demand. I think I'm going to increase my spend on retailer recruitment. I want to be right around $100. So I'm going to adjust those numbers just enough to stay right around that $100 mark on all of my retailer recruitment budgets. Okay, so I adjusted my marketing mix to make my compensation and facilities. I want to optimize my factory, make sure that I'm using 100% of my factory. Okay. So if I go over here to finance and cash flow, what I see, I've got 50 million bucks left, right? You want to take a look at your capital structure every single year, right? You've still got some loans outstanding. One of them is at 7.5% and one is at 6.5%. And you can get new money at 5%. Okay, so I'm going to pay off this 7.5% loan and this 6.5% loan. My dividend last year was 80 cents. I think I'm going to leave that dividend at 80 cents. I could increase it a little bit if I wanted to. Let's see what my dividend payout ratio was last year. For Company J, dividend payout was 33.2%. I'm going to go back to finance and cash flow. My projected profit is 318. If I'm going to do a third dividend payout, I'm going to make that $1.06, $1.06 per share, right? I'm just looking at my earnings per share, and I want to pay out a dividend that's commensurate with what I paid last year, and that's a 33% dividend, right? I want to repurchase all of the stock that I can because remember, we have the preference for OPM. That's other people's money, right? So we're going to repurchase 446,000 shares of stock. And in order to do that, we need $141,850,000. Otherwise, we're going to have a big old honking overdraft loan, and we don't want to do that. So I'm going to take out a bank loan for 155 million to cover my cash shortfall. That tells me with that, I could generate a little bit of interest income. I don't want to receive interest income because they're only paying 0.5%, right? But if I drop the amount of my loan, it tells me when I drop it by $2 million that I have a high potential for overdraft. So I'm just going to leave it at $155 million to give myself a little bit of cushion. Okay. So I know I covered a lot in this video, right? We changed our marketing mix by changing our drone to our camera to 5 stars, our drone to 5.2 stars. I optimized the way that I'm producing it to get our costs down. And see, indeed, I did get my cost on the drone down to $970. We changed our marketing mix by changing our promotion such that we optimize demand And we raised our price because what we're really after is making sure we use 100% of our factory. We did the same thing on our drone to optimize our demand, our market share, so that we use 100% of our drone facility. We increased our compensation decisions on our workers so that we can continue to get the best out of our workers. We've already done the robotics upgrade. We did that last year. And look at the money we're saving by having done the robotics upgrade. My image rating is a 78, so that really doesn't call for me to do any additional corporate social responsibility because I'm meeting the investors' expectations. My credit rating is A minus. My return on equity is 42.9%. My capital structure looks great. I'm in wonderful shape here, so I'm going to save those decisions. Okay. I've given you a ton of information here, and I'm getting an error message that I can't save my decisions because I've got too many windows open, but you get the idea. Okay. Make sure you save your decisions. Make sure that you do everything that I've outlined here if you're going to implement the integrated differentiation strategy. Okay. Thanks so much.